We all read shareholder letters, the polished page, where CEOs brag about wins and smooth over misses. But what if the most important sentence is the one that isn't there? Imagine a CEO who used to publish cash runway numbers every year, and this year, silence. That omission can cost you more than a missed metric. It can change how you trade, lend, or vote. Stick around. And in the next 12 minutes, you'll learn exactly how to turn those silences into high-value questions and immediate actions. Shareholder letters are carefully edited narratives designed to persuade. The same edit that adds a paragraph can also remove one, and omissions are often strategic. This is an educational guide to reading absences, missing metrics, no M&A commentary, silence on cash, omitted risk language, skipped succession notes, and what each silence probably means. You'll get a systematic checklist you can use after any annual letter, plus specific trading, fundraising, and governance moves you can make right away. Quick note: this is educational content only, not personalized financial, legal, or investment advice. Consult a licensed professional before acting. Start with a basic principle from disclosure theory. Voluntary communications are choices. Management decides what to reveal and what to withhold. Academic research shows voluntary disclosure reduces information asymmetry and improves liquidity. Therefore, a deliberate reduction in voluntary disclosure often increases uncertainty, volatility, and the cost of capital. The absence of one historically consistent disclosure often signals a material change in either company health or management incentives. Consider a company that reported free cash flow for 5 consecutive years and suddenly omits it. Why would they do that? Possibilities include negative FCF, increased volatility from one-time items, or planned financing, where management doesn't want to highlight a weak cash profile. Traders and investors react to increased uncertainty, bid-ask spreads widen, analyst models get blown up, and equity risk premium move. Did you expect that a missing number could be as informative as bad news? Often it is. Silence about cash, liquidity runway, or covenant headroom is one of the highest priority omissions. Cash is binary in a way revenue isn't. You either can meet obligations or you can't. If a shareholder letter that historically calls out unrestricted cash, debt maturities, or covenant headroom goes quiet, ask immediate questions. What is unrestricted cash today? How many months of runway do we have at current burn? Are any covenants close to a breach? Actionable follow-ups include widening stop losses, considering short-term hedges, or pausing new allocations until the company files a 10Q or 8K that discloses cash. For lenders or potential investors, request audited cash balances, a covenant testing schedule, or a borrowing base certificate. For founders and investor relations teams, be prepared to answer these exact questions. Silence will be filled with speculation. But missing cash isn't the only silence that speaks loudly. If a company historically discusses its M&A pipeline and suddenly omits it, read that omission against a few possibilities. They could be pausing acquisitions because valuations are high or deal flow is weak. They could be preparing a stealth acquisition and don't want to tip targets or regulatory reviewers. Or they could have abandoned the strategy because previous deals underperformed. Benchmark the current letter against last year's and against peers in the same sector. If peers are discussing strategic deployments and this company is quiet, that's notable. Ask investor relations directly whether M&A is paused and why. If you're a lender, tighten representations and warranties around change of control provisions. If you're a trader, this omission can imply a change in growth expectations. Consider revaluing multiples or adjusting option positions. Here's a practical trick. Check job postings. A hiring freeze in development or corporate strategy teams can confirm a pause in M&A activity. Silence on updated risk factor language and forward-looking boilerplate is subtle but powerful. Companies typically include cautionary language to invoke the safe harbor for forward-looking statements. If a shareholder letter trims risk paragraphs or omits updated risk factor language, two interpretations are common. Management is trying to downplay new or escalating risks, or legal counsel judged the letter sufficiently non-forward that less boilerplate was needed. If new risks exist, and they aren't acknowledged in the narrative, management may be avoiding bad headlines, which increases tail risk for investors. Cross-check the 10K risk factors and recent 8Ks. If those filings have new risk disclosures, but the shareholder letter is silent, ask why. A governance move is to request that the board include an independent risk update at the next shareholder meeting or demand an 8K if material new risks are present. Traders should treat unexplained silence as a reason to increase the margin of safety. In founder-led or aging management companies, succession language is mission-critical. If past letters reassured investors about continuity and the new letter removes that reassurance, it's more than a stylistic change. Omission could indicate uncertainty about successors, internal conflict, or that the founder is preparing an exit without informing the market. Governance-minded investors should request board minutes on succession planning, ask for details on key person insurance, or propose a special shareholder meeting for clarification. For venture investors or private backers, include explicit succession covenants in future term sheets. A quick test: look at insider trading. If executives are selling and succession language disappears, alarm bells should be louder. Another important omission is the absence of reconciliations for non-GAAP metrics. Companies usually provide reconciliations to preempt SEC or analyst scrutiny. If a letter touts adjusted EBITDA, core revenue, or other non-GAAP measures without reconciliations, you can't verify the adjustments. Are they removing one-time costs or masking recurring expense growth? Demand reconciliations via investor relations or through filings. If you're valuing the company, apply a larger disclaimer adjustment to non-GAAP metrics or fall back to GAAP-only models. For governance, push for an audit committee briefing to explain why reconciliations were omitted. Here's a practical checklist you can use immediately after any shareholder letter. First, benchmark historically. What did the company include last year that's missing now? Cash, free cash flow, KPIs, M&A discussion, succession notes, risk language, reconciliations. Second, peer check. Do direct competitors disclose the missing item? If so, flag it higher. Third, filing cross-check. Search the 10K, last 8K, and latest 10Q for the missing disclosure. Fourth, draft 3 direct investor relations questions, one about numbers, one about strategy, and one about governance. Fifth, action mapping. For each omission, pick one immediate trade move, one fundraising ask, and one governance request. Quick example: if cash is missing, trade move equals reduce position or buy a downside hedge. Fundraising ask equals monthly cash reporting plus a borrowing base certificate. Governance request equals demand a special update to the board. A scoring hack: assign 1 to 5 points per omitted category and consider anything above 10 as elevated disclosure risk. To recap, omissions in shareholder letters are intentional choices with real consequences. Missing cash or free cash flow is high priority. Act now. No M&A commentary could mean a pause or stealth activity benchmark and ask. Silence on risks or succession are governance red flags. No reconciliations for non-GAAP metrics increase model risk. Use the checklist. Benchmark historically and against peers. Cross-check filings. Ask 3 direct IR questions and map each omission to a trade, fundraising, or governance action. If you want a quick script to DM or email investor relations, here are 3 direct questions you can copy verbatim. Can you confirm unrestricted cash and committed liquidity runway in months at current burn as of the date of your inquiry? Has there been any change to M&A strategy or pipeline since the last shareholder letter? And if so, please outline the primary drivers. Does the board have an updated succession plan for named executives? And can you provide a timeline for any planned transitions? This is educational only and not personalized advice. If you act on these signals for trading, lending, or governance, Consult a licensed professional first. Next time you read a shareholder letter, don't just look for what's said, look for what's missing.